Hello everyone, my name is John Paul, DayTradeToWin.com. Today's video is going to cover the 3 different types of price action that every trader should know before you jump into the market. Understand what you're getting yourself into. Is the market slow, fast, trend, not a trend, a waste of time, and so on. Before we begin, remember trading is risky. Don't trade with funds you cannot afford to lose. You can make a lot of money trading. You can lose a lot of money trading. Talk to your broker. Understand the risks involved with trading. We do offer a free simulator to get you started, so that way you can get your feet wet, understand what trading is all about, learn, and then you can get into it if it's right for you. So remember that the price action dominates traders. If the market is slow, if the market is fast, if we're in a trend, if we're not in a trend. So when we look at the chart, I have here a chart of the E-mini S&P. The market's been open about 2 hours here, and what we're looking at is a trend. So how can we understand that a trend and buying and holding is better than, for example, buying and selling and getting out on a small target or even trailing a stop? Well, one of the things that I tell all the traders that I work with is to add the ATR, the average true range, to the chart. Here on NinjaTrader, you right click on the chart, choose indicators, and right here in alphabetical order the ATR. I use a setting of 4, which allows me to see the last 4 candles that have just plotted on the chart what type of price action exists. So the higher this value, the more likely that you have to increase your stop and that the market will be a trending day or a trending market. There's more money to be made, but there's also more risk involved. So what I look at here is, what is the ATR telling me? It's telling me that currently the last 4 candles right over here are very volatile, and the ATR being at 7 presents a little bit of an issue. My stops have to be very large, or I have to be very careful when I trade, because each of these candles within 5 minutes could move 7 points up or 7 points down. So this is a huge move every 5 minutes that the market could make. When the market is typically above 4, I'm going to put a line here at 4 on the ATR. When the ATR is above 4, we can expect a trending day. So one of the days that price action gives us is a trending day. Look at when the ATR is above 4, 3.5, 4, 5. You can see more of a trending aspect, either up or down. Not direction, just it's trending up or trending down. Those type of days you could hold on to a trade. You can trail a stop, maybe have a larger stop as well. But typically we have a trending day when the market is this volatile. Look at the ATR to tell you that. We have another type of day when we would consider that normal. What's a normal day where we buy, we sell a few times throughout the day? We look at the targets being 1 times the ATR, and therefore when you have the, let me just go back here to a situation where the market is a little bit more normal. So you see here that the ATR is below 4, and we have, this is overnight, the market being a little bit slower. It's still good to trade. I like to see the trade here above 1 point. And so if you're looking at the market during this type of activity where the ATR is between 2 and 4, it's normal. You buy, you sell, take 1 times the ATR. Even though it could be trending, you still have a lot of opportunity as the market does something like this. Right? So each of these moves is large enough for you to get in and to get out and not waste your time. Use a time-based stop, use a normal catastrophic stop. These are all things that we teach in the programs that we offer. But the idea behind looking at the ATR is indicating to us it's not necessarily a trending day, but I can take these moves where I can buy and sell and make money while trading without large losses, or it's not overly volatile. So I like to see the ATR between 1 and 4, 2 and 4. That's healthy, normal market movement. And that's on the E-mini S&P. And for other markets, the ATR just has to be adjusted for tenths or ticks, but it really gives you the same information. The E-mini and the NASDAQ works in points. Then we have a situation where the market is slow. It's a waste of time. You get in and nothing happens. It's just flip-flop and chop. So if I look here, let me go back here at a day where the market is slow or slower than normal. You can see that it's harder to trade. Let me just go back here. looking for a day where the market is, in fact, slow. Well, what I would consider slow. Okay. All right. So here we have right here. Here we have a situation where it's really a range, a chop, a whipsaw. The market is basically flat. Okay. And if you look here at the ATR, it's also very slow. So when you have a slow ATR, slow market, slow movement, it rarely trends. It rarely gives you an opportunity for a move where you could buy and sell in a 20-minute time frame where you make a couple of points. What it does, it just stays flat. It does this. Back and forth, back and forth. And so when you see the market trading at about 1 point or lower, and this is on a 5-minute chart, we're looking at the ATR on a 5-minute chart, you have to expect more chop, more whipsaw. And one of the giveaways are dojis, candles with large wicks. So if you see here, these candles with wicks right over here, this tells me that we're going to have a lot of chop and whipsaw and the market's just going to be flat. This is not an optimal time to trade. You should wait until the market speeds up a little bit. Again, the ATR 1.5, 2, getting to normal. Don't expect a trend, expect more chop and flip-flop. So the three types of price action days, price action charts that you should be looking at before you jump into the trade is the market volatile? Expect a trend. You may have to have larger stops. You can trail a stop, and you can also make a little bit more money on those type of days with more risk. The normal day here is between, let's say, 4 and 2 points, between 4 and 2. Here, this is a typical day where you could see the market becoming between here. So I'll show you what that means here, like this. So when you have the market between 2 and 4 points, the moves are 2 to 4 points. You can make 2 to 4 points on each trade in a fairly short amount of time. When the market becomes slower, closer to 1 point, what you have is chop. When the market is above 4, volatility. We're going to see a lot of volatility with movements and continuing either up or down. If you have any questions, email me at support@DayTradeToWin.com. The next mentorship class, which includes all the courses in the software, begins September 15th. I still have a few seats available. Let me know if you're interested. You can sign up online at DayTradeToWin.com. Until next time, good trading. If you want to learn more about trading, visit DayTradeToWin.com. Subscribe to the DayTradeToWin YouTube channel, the next mentorship class where we cover all of these methods with lifetime licenses for the software